Ladies and gentlemen, what I'm about to reveal to you in the next several minutes will fundamentally change how you understand the global financial system, and it's happening right now, at this very moment, while most people are completely asleep at the wheel. The silver market, that seemingly quiet corner of the precious metals world that most investors ignore, has just become ground zero for what could be the most explosive wealth transfer of the 2020s. The shocking part, the part that should send chills down your spine, is that while Western banks are playing games with paper contracts and digital ledgers, two major players on the world stage are quietly, systematically, methodically draining physical silver from the global vaults at a pace that would make your head spin. China and Venezuela aren't talking about it on CNN. They're not holding press conferences. They're not tweeting about it. But their actions are screaming a message that everyone needs to hear. And that message is this: the game has changed, the rules have been rewritten, and if you're not paying attention right now, you're about to be left holding worthless paper while they walk away with real, tangible wealth. But here's where it gets really interesting. Here's where the story takes a turn that even the most seasoned market observers didn't see coming. Right now, as I speak these words to you, silver is trading at $73.56 per ounce. And that number alone should make you sit up and take notice, because just 12 months ago, silver was languishing below $30, struggling to break resistance levels that had held for years, dismissed by mainstream analysts as just another commodity in a boring sector that nobody cared about. But something happened. Something fundamental shifted in the global markets. And that shift has created what I can only describe as the perfect storm. A convergence of forces so powerful, so unstoppable, that even the massive banking institutions that have controlled precious metals pricing for decades are starting to lose their grip. The price you're seeing on your screen, that $73 figure, that's not the whole story, not even close. Because what's happening in the physical market, what's happening when real buyers try to purchase real silver for real delivery, that tells a completely different story. A story of premiums exploding to levels never seen before. A story of wait times stretching into months. A story of dealers struggling to source material because the vaults, my friends, the vaults are running dry. Let me paint you a picture of what's really happening behind the scenes, because this is where the manipulation, the deception, the absolute audacity of the banking system becomes crystal clear. When you look at the COMEX, the Chicago Mercantile Exchange, where silver futures are traded, you'll see millions upon millions of ounces changing hands every single day. Enormous volumes of silver being bought and sold with the click of a mouse. And the banks, the trading desks at JP Morgan and Goldman Sachs and HSBC, they love this paper game because they can create infinite supply with zeros on a computer screen. They can naked short the market, dumping thousands of contracts in minutes to smash the price down whenever it gets too high, too uncomfortable, too threatening to their positions. They've been doing this for years, paying fines when they get caught, laughing all the way because the fines are pocket change compared to the profits they make manipulating prices. But here's what they didn't count on. Here's the crack in their armor that's getting wider every single day. Someone has to actually deliver physical silver when those contracts mature. Someone has to produce the real metal, and that someone is discovering that there's a massive, gaping disconnect between the paper silver traded in New York and London and the physical silver that exists in warehouses and refineries around the world. The Chicago Mercantile Exchange, in a move that sent shockwaves through the trading community just weeks ago, raised margin requirements on silver futures not once, not twice, but in rapid succession, forcing traders to put up more capital to hold their positions. And why would they do that? Why would the exchange suddenly demand more collateral unless they were genuinely concerned about volatility, about the risk of default, about the possibility that the paper market could completely decouple from physical reality? When exchanges raise margins, it's because they're scared. It's because they see something brewing that could blow up the entire system, and what they're seeing right now should terrify anyone who understands how these markets actually function. The volatility in silver has reached levels that make even seasoned traders nervous, with intraday swings of 5, 6, 7% becoming commonplace, the kind of price action you'd expect from a speculative cryptocurrency, not a commodity with thousands of years of history as money. But that volatility isn't random, it's not just market noise, it's the symptom of a market that's being pulled in two completely opposite directions, with paper shorts trying desperately to keep prices contained while physical buyers are willing to pay almost any price to secure actual metal. Now let's talk about China, because what China has done in recent months is nothing short of a masterstroke in economic warfare. A move so brilliant, so calculated, that most Western analysts completely missed its significance until it was too late. China, which controls approximately 60 to 70% of global refined silver production and exports, announced new licensing requirements for silver exports, seemingly bureaucratic rules about permits and paperwork that sounded boring and technical to anyone not paying close attention. But make no mistake, this wasn't about bureaucracy. This was about strategic control. This was about China looking at the global silver market and saying, we're going to decide who gets silver and who doesn't. We're going to decide how much flows to Western markets and how much stays in Asia. And we're going to use this leverage to reshape the entire supply chain. When a country that produces the majority of the world's refined silver suddenly puts restrictions on exports, even just the threat of restrictions, even just the uncertainty about whether your shipment will be approved, that creates panic in the market, that creates hoarding behavior, that creates a scramble for alternative sources that simply don't exist in sufficient quantities. And here's the kicker. Here's the part that should make every investor's ears perk up. China isn't restricting these exports because they want to drive up prices for profit. They're restricting exports because they need the silver themselves, because their domestic industrial demand, their solar panel manufacturing, their electronics production, their electric vehicle battery systems, all of these sectors are consuming silver at absolutely staggering rates, rates that are accelerating month after month after month. The solar industry alone, just that one sector, is projected to consume over 200 million ounces of silver this year. And that number is expected to double, perhaps even triple, over the next 5 years as countries around the world race to meet climate commitments and transition to renewable energy. Every single solar panel requires silver. There's no substitute that works as efficiently, no alternative that conducts electricity as well. And as solar installation rates skyrocket globally, that demand is creating a structural deficit in the silver market that simply cannot be met by current mining production. Mining companies can't just flip a switch and produce more silver. It takes years to bring new mines online, billions in capital investment, exploration, development, permitting, construction. And even then, most silver isn't even mined as a primary product. It's a byproduct of copper and gold and lead and zinc mining, which means silver supply is largely dependent on the economics of completely different metals. If copper prices are low, if gold miners cut back production, silver supply gets squeezed as a secondary effect, creating this bizarre situation where the metal with exploding industrial demand has a supply chain that's almost entirely dependent on other markets. But it's not just solar panels, it's not just China's industrial appetite, because there's another player in this game, a player that most people didn't expect, a wild card that's adding fuel to an already raging fire, and that player is Venezuela. Now, Venezuela might seem like an odd character in this story, a country that's been economically devastated, politically isolated, struggling under sanctions and hyperinflation and mass immigration, but that's exactly why their silver accumulation strategy makes perfect sense, and it's exactly why it's so dangerous for the stability of global markets. Venezuela, sitting on the world's largest proven oil reserves, has learned the hard way what happens when your wealth is denominated in assets that can be frozen, seized, or sanctioned at the whim of foreign governments. They watched as billions of dollars in overseas accounts were locked, as gold held in the Bank of England was denied to them, as their ability to transact in the global financial system was systematically dismantled. And from that painful education, they drew a simple conclusion. Physical assets that you control directly, that sit in your own vaults on your own soil, are the only real wealth in a world where financial warfare is the norm. So Venezuela has quietly been accumulating physical silver, not through loud purchases that would move markets and attract attention, but through strategic positioning in the export market, through deals with miners and refiners, through barter arrangements with countries willing to trade goods for silver rather than dollars or euros. They're looking at China's playbook, watching how export restrictions create leverage, understanding that in a world where physical silver is becoming scarce, whoever controls supply controls power, and they're positioning themselves as an alternative source for countries that can't or won't deal with Chinese restrictions. It's a geopolitical chess move disguised as commodity trading. And the implications are staggering because it means that two major players, China and Venezuela, are actively working to corner physical silver supply, while Western markets remain focused on paper contracts and digital derivatives. The East is buying physical, the West is trading paper. And that divergence, that fundamental disconnect, is about to create an explosion in pricing that will leave paper holders absolutely devastated. The evidence is everywhere once you know where to look, once you understand what you're seeing. Physical premiums in Asian markets, the amount above spot price that buyers must pay to actually secure metal for delivery, have exploded to levels that are completely unprecedented in modern market history. In Singapore, in Hong Kong, and Tokyo, dealers are charging premiums of 15, 20, even 25% over the COMEX spot price. And customers are paying it. They're paying these premiums without hesitation because they understand something fundamental. Better to pay a high premium for real silver than to hold a paper contract that might never be honored when the system breaks. In Shanghai, the premium over London prices has widened to levels that would normally trigger massive arbitrage flows, with metal shipping from west to east to capture the price differential. But that arbitrage isn't happening because there's no metal to ship. because Western vaults are already running on fumes, because every ounce that becomes available is immediately snapped up by buyers who understand that this opportunity to acquire physical silver at anything close to current prices might not last much longer. COMEX inventories, the silver sitting in registered vaults available for delivery against futures contracts, have dropped to multi-year lows, levels that should be raising alarm bells throughout the financial system. We're talking about eligible and registered silver stocks that have declined by hundreds of millions of ounces over the past several years, a steady, relentless drawdown that shows no signs of stopping. And while some of this metal moves into the eligible category, where it's still in the vault but not available for delivery, the trend is unmistakable. Physical silver is leaving the system, moving into strong hands that aren't selling, disappearing into private vaults and strategic reserves and industrial stockpiles where it won't return to the market regardless of price. The banking establishment wants you to believe this is normal market fluctuation, wants you to think that inventory levels always go up and down and there's nothing to worry about. But let me ask you this. If everything is fine, if supply is adequate, if there's no shortage, then why are premiums exploding? Why are delivery times stretching longer? Why are mints around the world rationing sales and implementing allocation systems? Why are major dealers warning customers about limited availability? These aren't signs of a healthy, balanced market. These are signs of a market in crisis, a market where demand far exceeds supply, a market that's one major catalyst away from complete chaos. And the industrial demand story, the structural drivers that are creating this insatiable appetite for physical silver, this isn't speculation about what might happen. This is reality happening right now, accelerating with each passing month. Electric vehicles require significant silver content in their electrical systems, their battery management systems, their power electronics, and as EV adoption accelerates globally, as countries ban internal combustion engines and mandate electric vehicle sales, that demand is growing exponentially. The artificial intelligence revolution that everyone is talking about, the data centers being built to handle AI workloads, the servers and networking equipment and power infrastructure, all of this technology requires silver, needs silver, cannot function efficiently without silver's unique properties as the most conductive metal on Earth. 5G networks, smart cities, Internet of Things devices, renewable energy storage systems, every single technological advancement that defines our modern world has silver somewhere in its supply chain, often in ways that most people never see or think about, but that demand is real, it's growing, and it's permanent because once you build a solar farm or an EV charging network or a data center, that silver's gone, it's locked into infrastructure, it's not coming back to the market no matter what happens to price. For 5 consecutive years now, the silver market has run a structural deficit, meaning that annual demand has exceeded annual supply year after year after year, with the gap being filled by above-ground stocks, by inventory drawdowns, by recycling and secondary supply that has its own limits. You can't run deficits forever. You can't keep consuming more than you produce indefinitely. Basic mathematics tells you that eventually you run out, eventually the inventory is gone, eventually the secondary supply dries up. And when that happens, when that moment arrives, the price adjustment required to balance supply and demand will be absolutely catastrophic for anyone holding short positions or paper promises. The banks know this, the big trading desks know this, that's why they're quietly covering shorts, that's why margin requirements are rising, that's why there's this palpable nervousness in how silver futures are being managed, because the people at the top of these institutions understand that they're sitting on a powder keg, and they're desperately trying to exit their positions before someone lights the fuse. Now let's connect all these pieces. Let's see how this tapestry of manipulation and geopolitical maneuvering and supply deficits weaves together into the bigger picture. Because this isn't just about silver, this is about the fundamental architecture of the global financial system and who controls it. For decades, the Western banking system has maintained its dominance through control of financial infrastructure, through the dollar as reserve currency, through markets where price discovery happens on their exchanges according to their rules, with their ability to influence outcomes. Silver and gold, precious metals that have served as money for millennia, represent a threat to that system because they're alternatives, they're assets that exist outside the banking system, that can't be printed or inflated away or controlled through monetary policy. So there's been this concerted effort, documented through lawsuits and whistleblower testimony and regulatory fines, to suppress precious metal prices, to make gold and silver look boring and unprofitable compared to stocks and bonds and other financial assets that keep people trapped in the banking system. But China and Russia, and now increasingly other nations, have been watching this game, understanding the manipulation, and they've made a calculated decision. Instead of fighting the paper price, instead of trying to win in markets rigged against them, they'll just buy the physical metal at suppressed prices. Thank you very much. Accumulating real wealth while the West trades derivatives. It's the ultimate judo move. using the opponent's strength against them, letting Western banks suppress prices through paper markets, while Eastern central banks and sovereign wealth funds vacuum up physical gold and silver at discount prices. And now, after years of accumulation, after building positions large enough to matter, China is pulling the trigger on phase 2 of this strategy, restricting supply, controlling exports, using their dominance of refining and production to dictate terms to global markets. They're essentially saying to the West, you can play your paper games in New York and London, but if you want actual silver, if you need physical metal for your industries, for your mints, for your technology, you're going to have to come to us, and you're going to have to play by our rules. Venezuela's positioning in this context becomes even more interesting because they're offering an alternative, a Western Hemisphere source for countries that don't want to be entirely dependent on Chinese supply. But the catch is that Venezuela wants payment in real value, in gold or other commodities or favorable trade terms, not in dollars that can be frozen or euros that can be sanctioned. They're building a parallel system, a network of trade relationships outside the dollar hegemony, and silver is one of the tools they're using to do it. This is economic multipolarity playing out in real time, the unipolar world order fracturing into competing spheres of influence, and precious metals are right at the center of this transformation because they're the one form of wealth that all sides agree has value, that can't be canceled or deleted or printed into oblivion. The money flows tell their own story, painting a picture that becomes clearer when you look at where capital is actually moving in real time. Exchange-traded funds that hold physical silver, the big ETFs that allow investors to gain silver exposure without taking personal possession, have seen absolutely massive inflows over the past 18 months, billions of dollars flooding into these vehicles as institutional investors and hedge funds and family offices wake up to the supply deficit story. But here's what's really fascinating. Here's the detail that reveals just how much fear and urgency is building in the market. While ETF inflows are substantial, the premium on physical bullion, the amount that individual investors are willing to pay for coins and bars that they can hold in their hands, has grown even faster, suggesting that the smart money, the people who really understand what's coming, aren't satisfied with ETF shares. They want metal they can control directly. The mint data supports this, with government mints from the United States to Australia to Austria reporting record sales, struggling to keep up with demand, implementing rationing systems and customer limits, because they simply cannot source enough silver blanks from refiners to meet orders. When you see this kind of divergence, when you see both institutional money flowing into ETFs and retail investors scrambling for physical coins and bars, when you see both ends of the investment spectrum moving in the same direction simultaneously, that's a signal. That's the market telling you something important is about to happen. Markets don't typically see this kind of coordinated buying across all investor classes unless there's a fundamental shift underway, unless the underlying dynamics have changed so dramatically that everyone from sophisticated hedge funds to first-time precious metal buyers can see it. And the price action reflects this, with silver showing resilience that surprises even bulls who've been in this market for decades, bouncing back from every paper price smash with increasing strength, forming a pattern that technicians recognize as accumulation, as smart money-building positions while trying not to push price too high too fast. The paper market manipulation continues, make no mistake about that, with sudden dumps of thousands of contracts during thin trading hours, with suspicious price action that coincides perfectly with options expiration dates, with all the classic signs of managed markets where large players are trying to defend certain price levels or trigger stop losses or influence technical indicators. But the manipulation is becoming less effective, the paper price is becoming less relevant, because when you can sell 1,000 contracts in 30 seconds and the price barely budges, when you throw everything at the market and it just absorbs the selling and grinds higher, that tells you that the underlying bid, the fundamental demand for silver, has overwhelmed the ability of paper shorts to control price. It's like trying to hold a beach ball underwater. You can do it for a while with enough force, but eventually your arms get tired, eventually you have to let go. And when that happens, when the paper shorts finally capitulate and cover their positions, the explosive move higher will be something to behold. We're approaching a moment of reckoning in the silver market, a point where the accumulated tensions between paper and physical, between East and West, between infinite paper supply and finite physical reality, will resolve in a price discovery event that redefines what silver is worth in the modern economy. Think about it logically. Think about the setup. You have industrial demand growing faster than supply. You have investment demand accelerating. You have two major geopolitical players actively working to control supply. You have inventories at multi-year lows. You have premiums exploding in physical markets. You have a history of price suppression that's documented and proven. And you have a paper market where short positions are massive and concentrated in a handful of banks. Every single one of these factors individually would be bullish, would suggest higher prices ahead. But when you combine them all together, when you see them converging simultaneously, the bullish case becomes overwhelming. The logical conclusion becomes inescapable. The banks that have manipulated silver for years are in a trap of their own making, caught between their short positions and the physical reality of constrained supply, between their desire to keep prices low and the market forces pushing prices inexorably higher. They can't cover their shorts without pushing prices up, but they can't hold their shorts forever in the face of relentless physical demand and structural deficits. They're bleeding inventory every month, watching registered stocks decline while delivery demands increase, knowing that at some point the math just stops working. The system breaks, and they'll face delivery failures or force majeure or some other crisis that exposes the fraud at the heart of the paper market. The longer this goes on, the worse their position becomes, because every month of deficit draws down inventory further, every month of Chinese export restrictions tightens supply further, every month of industrial demand growth makes the structural problem more severe. And when the break comes, when the paper price finally snaps and races to catch up with physical reality, the move will be fast, brutal, and absolutely devastating to anyone on the wrong side. We could see silver double in weeks, triple in months, as decades of suppressed price action unwind all at once, as short covering creates a feedback loop of higher prices, forcing more covering, forcing even higher prices. The comparison to nickel's short squeeze in 2022, when prices went from $20,000 to over $100,000 per ton in a matter of days before the exchange had to halt trading, that's not hyperbole, that's not exaggeration. That's a realistic template for what happens when paper markets lose control and physical scarcity meets unlimited short positions. The London Metal Exchange had to cancel trades, reverse transactions, protect short sellers from complete annihilation because the alternative was systemic collapse. And the same kind of intervention might be necessary in silver if the squeeze plays out as dramatically as the fundamentals suggest it could. For investors, for anyone paying attention to these markets, the message is clear and urgent. Physical silver, real metal that you hold directly or store in allocated accounts where you own specific bars, is the only thing that matters when this situation resolves. Paper silver, whether futures contracts or unallocated pool accounts or certain ETFs with questionable redemption terms, carries counterparty risk. Carries the risk that when you try to convert paper to physical during a crisis, you'll discover that the physical doesn't exist, that your claim is one of many claims on the same underlying metal, that you're going to get settled in cash at a price that doesn't reflect true market value. The time to position yourself, the time to make the decision about whether you want exposure to this setup is now, right now, before the break happens, before premiums gap even higher, before availability becomes truly constrained, before the price discovery event that everyone in this market knows is coming. China is raiding the vaults, Venezuela is raiding the vaults, industrial demand is raiding the vaults, and the vaults are running dry while most investors remain blissfully unaware of what's happening. The global silver squeeze is real, it's happening in real time, and it's building toward a climax that will reshape precious metal markets for a generation. The East versus West pricing war has already begun, with Shanghai premiums signaling that physical metal is worth far more than COMEX paper suggests, with arbitrage breaking down as geographic dislocations persist instead of correcting. The structural supply deficit that's persisted for 5 consecutive years shows no signs of reversing, with industrial demand growth outpacing any realistic production increases, with above-ground stocks depleting month after month, with recycling already maxed out and unable to fill the gap. The implications for investors are profound. The implications for the global economy are staggering, because when silver breaks free from paper price suppression, when it finds its true value based on supply and demand fundamentals without banker manipulation, that repricing will send shockwaves through every market, every currency, every carefully constructed narrative about inflation being transitory and everything being fine, and the system being stable. Silver is the canary in the coal mine, the early warning system, the crack in the dam, and that crack is getting wider with each passing day. The banks know it, China knows it, Venezuela knows it, smart money knows it, and now you know it too. What you do with this information, how you position yourself in the face of what's coming, that's your decision to make. But understand that this is not a drill, this is not theoretical, this is the real deal playing out in real time with real consequences for anyone holding wealth in financial markets. The trap is set, the players are in position, and the spring is coiled tighter than it's ever been, ready to release energy that's been building for years, ready to deliver the kind of move that creates generational wealth for those positioned correctly and devastating losses for those caught unaware. And the clock is ticking. Subscribe for market insights.